Welcome to Club E. Hi, I'm Rick Brimacombe of Brimacombe and Associates. I am your architect of business growth and will work with you to unlock your potential and amplify the scale of your company. Today, we're talking about exit strategies for 2021. I want to thank our sponsors, Irish Titan, an e-commerce and web development firm, Boulay Group, CPAs and advisors, Highland Bank, a locally owned community bank, Romaine Berg, a digital marketing agency, Minnesota Sales, a sales acceleration firm, a new sponsor, Voyager U, provider of training resources and a community for you to launch an independent career. Courses can be found in the courses section of clube.com. And last but not least, the Network Connect. Subscribe and like our Club E channel. That will allow us to tailor content for you, as well as let you know when we are going live. It's right down by the video. Again, hit the subscribe and like. You can also now catch Club E on your favorite podcast platform, Apple, Google, Spotify, Stitcher, and many others. All right, I'd like to introduce today's panel. I have Chad Johnson of Cherry Tree, Dean Willer of Winthrop and Weinstein, and Ben Hangge of Highland Bank. Welcome, guys.
Thanks, Rick.
And then just a reminder for our audience, you can find Chad, Dean, and Ben and their respective email addresses in the comments field, and that will allow you to reach out to them after the fact. All right, let's hear from you guys. Tell us a little bit about yourself, your background, your firm, and the various activities you're involved with. Hey, Chad, let's start with you first.
Fantastic. Thanks, Rick. So I have been with Cherry Tree as an investment banker focused on M&A advisory work for about 14 years now. Prior to that, I ran a software company and also had done corporate development for a publicly traded company here in town. I tend to focus on technology companies and have been also working with a number of education companies nationally.
And Chad, you and I have known one another going back almost 20 years, so it's an honor and a pleasure to have you here on the session today.
Yeah, thanks, Rick. Absolutely, that was it was a great way to get started, and it's been fun working with you over the years as well.
Yep, and Dean, you and I have also crossed paths a number of times on the work front on a variety of different projects. Tell us a little bit about you, your firm, and the kinds of projects and clients you work on.
Sure. So my name is Dean Willer. I'm a corporate attorney. I've been here since 2005. After I got out of MBA school, got a degree in finance after law school because I didn't think I had enough education. I've been working here for, like I said, for about 15 years, primarily focused on M&A advisory, M&A legal advisory work, as well as corporate work. So, you know, kind of the classic 80-20 rule, your 20% of your clients take about 80% of your time, and the majority of my other clients are in the corporate work, corporate environment. So you do, you know, everything from formation to capital raising to, you know, the everyday contracts and employment, things like that, all the way up through an eventual sale. But the majority of my work is focused on providing M&A legal advisory services.
Okay, thanks, Dean, for joining us today, and I appreciate the opportunities we've had over the years to work with one another. And Ben, Highland Bank has been an ongoing sponsor of Club E, so thank you for your support there. And you and I have had an opportunity also to interact on a variety of different projects. Tell us a little bit about yourself and your practice.
Yeah, certainly. Thanks, Rick. Thanks for having me today. I am a vice president commercial banker at Highland Bank in our St. Paul office. Highland Bank is over a $500 million asset bank, and we have a legal lending limit of about $10 million. And we have a focus on financing ownership change transactions. I've been in the banking industry for about 16 years now. I'm passionate to try to help business owners succeed, and I try to make banking easy by demystifying the credit process. As I mentioned, my main focus within the commercial banking sphere is to provide financing for ownership changes, and that's everything from partner buyouts to strategic acquisitions to private equity acquisitions to recaps. And today I'll be looking at our topic from a slightly different perspective than Chad and Dean, in that I more so help buyers purchase businesses, whereas they're they're more involved in the details of the finer details of the exit planning process. I guess when I'm not working, I enjoy traveling with my wife and kids, golfing, and getting my heart broken by Minnesota sports teams every year.
That is for sure. And I have to say, all three of you guys have young kids at home. So is that correlated with the fact that I see all three of you in the office today?
Possibly.
Certainly for
Yeah.
me.
Yeah, exactly. If my kids were on the phone, if I was at home, this would be the Dean Willer family program.
All right.
They would all have their heads right around here.
I know you all have young kids too, so it makes the home front a little dicey given the circumstances that we all find ourselves in. All right, so the way today is going to work is that I have prepared a list of questions we're going to work through with these guys. You can put questions into the comments field, and we will do our best to also include those. Hashtag today is exit strategies, hashtag exit strategies. And if you would like to get in touch with any of our panelists, again, their email addresses will be in the comments field. All right, so no particular order as to the answer, but question for our panelists here. Why do you think it's important for all business owners to have an exit plan?
I can start just to break the silence, but my own 2 cents is you end up in the situation where if you haven't started thinking about it in advance and you start to think about and you get to the point where you're ready to think about an exit, if you haven't laid the foundation for that exit, you're either going to be selling at a low value or a valuation that isn't very exciting for you, or you're going to end up at in a position where you have to work potentially longer, be involved potentially longer than you intend on it. Or I guess the last piece of it is you may miss a great opportunity to sell in the right market cycle. So, for example, we're selling a business right now where the first question a lot of people ask because the owner wanted to retire is, do you have a solid number two? Is there a guy that can step up and take over for you, or are we going to have to bring somebody to the table? And if you sold to a strategic partner, it may not be that big of a deal, but if you sell to a financial buyer, they're going to want to know that they don't have to go source your number two. So the good answer is yes. He about 4 years ago started bringing somebody along and making him someone that was really going to be his successor. He was sort of his COO up and through now, and he's been really well groomed to be the CEO. And I would think that was an area that really added value, makes it a lot easier to sell. And there's a lot of things like that where if you just think ahead and start making good choices about how you finance your business and the different kinds of contracts and different kind of persons you have to, like, are you operating to maximize EBITDA or maximize revenue? You end up with a position where you're in a good position, a good place to sell. And if you haven't started thinking about those things in advance, you may be in the business a lot longer than you may want to.
Yeah, I think that's a really good and comprehensive answer, Dean. There are things you can do to make sure that you get the best outcome possible, and it starts with what are your objectives, what are your goals, what do you want to accomplish, right? And then developing a plan accordingly and talking to people to understand how you can get the results that you're looking to get. So definitely makes sense to have a plan.
Certainly, and to just piggyback off of what Dean and Chad said, I guess I just come back to that everyone will exit their business someday, and so it's obviously important to have a plan in place. And something that I've heard time and time again is the 5 Ds of exiting your business, and it's death, divorce, disagreement, disaster, and disability. And so to just be prepared for any one of those unforeseen circumstances.
Absolutely. Absolutely. And in addition to a plan, you're really trying to take care of contingencies and be aware of potential blind spots. So what do you all see as the biggest blind spots that folks don't often see? And it could be on the sell side, or Ben, maybe you also have a comment on the buy side as well.
Yeah, I would say, and it's related to that idea of having a plan and why you want one. But the things that we tend to see are not understanding what the buyers or investors in your segment or for your type of business, what they're looking for, what things they value or put more value on or less value on. So the example Dean gave of the management transition could be one, but it could be other things like taxes, right? And I've certainly seen people get surprised by thinking, oh yeah, I've talked to my people about it and we're probably okay, to how big of an issue that can be when you start getting into more of the legal documents, which I'll defer to Dean on that, but that's something that I've seen come up in addition to just not realizing how the buyers in your market might value certain aspects of your business.
Yeah, I'll dovetail on what Chad said. Is it if you're, it's not thinking ahead. I've seen situations where the tax example is great, where all of a sudden we went back and looked at a client, we realized that that they had a significant issue with how they did their S corporation election, and we ended up having to escrow millions of dollars that they didn't intend to want to escrow just to deal with that situation. And it's those kind of risks. If you're thoughtful, if you're asking the right questions earlier rather than later, you're not going to get to the door and say, oops, because you're always going to run into bumps in the road, and the size of the bumps are going to determine whether you exit and you get the valuation that you expected or hoped or were anticipating.
Yeah, and I think I'll take a little more of a macro perspective on this question, but one of the biggest things that I've seen kill deals is sellers balancing their personal expectations for what their business is worth and or the price that they need in order to comfortably retire versus where the market is at for a business like yours. And sometimes those expectations don't meet reality, and the seller can never get a price that he or she is comfortable with, and the deal never happens.
Absolutely. Price expectations, and I'm sure we'll get into that later, when they're not in alignment with the realities of the market, that is definitely a trouble spot. All three of you play on the deal team side. So for a business owner looking to put together a deal team, what are some important characteristics to evaluate?
I would say experience is number one, right? I think of engagements that I've been involved in that have gone smoothly or not smoothly. And we've done work on the buy side and the sell side. That's probably the number one thing is, are you working with people that have been there before, they've been through it before? And then there certainly is value in people that understand your specific business or business model or market as well. I think foundationally experience matters, but then the next thing to me would be, okay, do they actually have some domain expertise?
Yeah, I agree with Chad. I think with the other piece of that I would add is make sure you find somebody that you really like and you're comfortable. And to use a military example, you want to be in the foxhole with, because for 6 months to 2 years, these are people that you're going to be working with day in, day out. And if you find somebody that that really cares about your business and that they're efficient and that they're going to be a deal advocate for you, as opposed to on the legal side, are they going to be a Dr. No? On the accounting side, are they going to be able to really understand your business and be able to articulate to a buyer? And on the advisory side, are they going to really learn your business and help deliver the answers? I can't tell you how important it is to have a good fit and a good feel. Chad's firm and our firm have worked together in a lot of deals, and they're really good at making the helping the people understand not only the business but also the emotional impacts of going through the business and working from soup to nuts with the business owner, not just handing it off as soon as the letters of intent was signed. And it's always been helpful. And you find somebody you feel really comfortable with taking you through that process and helping you, because this is probably, for a lot of people, it's the only time they'll ever do this. It's new to them. It's a little scary, and having somebody that you can really feel comfortable with advising you is really important.
Yeah, certainly. I think Chad and Dean nailed it. I mean, I just boil it down to experience, aligning your personalities, and trusting your deal team. And they did a great job of explaining it.
Okay. As we look at the current M&A environment, and alluded to valuations a little earlier. How have valuations fluctuated due to COVID, if at all?
Well, I'll start with that one. We something that we are looking at every day, every week, every month, every year, and we've been doing research on it throughout COVID. It has been interesting that certainly volume measured both in terms of numbers of transactions as well as the dollar value of transaction dropped off considerably right after COVID, right? So March was down a little bit, as we were in the middle of it. April was down significantly. Still some transactions getting done, but not a lot. But the market has been steadily coming back since then. In terms of number of transactions, we are in August, we're pretty close to kind of where we were in the 6 months leading up to COVID. Now, the value is not quite there. So it's, we're seeing things are back to some degree, but not completely. Valuations, however, I think is one of the fascinating things that we see for a lot of tech companies and especially SaaS companies, recurring revenue with decent growth. Often they're working in segments that have actually been more in demand during COVID. Valuations have held up very well. For other companies, especially for transactions that rely on some debt financing or for in other industries where there isn't a lot of recurring revenue and technology, now there we've seen valuations drop somewhat. So that just speaking at a high level, definitely got hit. Things are coming back pretty nicely. And especially for certain types of companies, the market's pretty strong right now. And I'd love to hear, Ben, maybe you could comment just on what you're seeing from on the debt side, because we certainly, for the private equity buyers, that's such a key component of what they're doing.
Yeah, we're certainly asking a lot more questions now than we were pre-COVID. And so I think that really it's a matter of just normalizing the financials and understanding if it was a COVID blip or kind of more of a longer term trend, and just kind of trying to normalize the financials and take out any impact that was a blip from COVID. But we are still certainly lending and doing deals. I think they're just taking a little bit longer to get comfortable with and to get done.
Yeah, and Ben, I know Highland Bank remained open through all this, and I know that you folks are still out there being active. So you didn't see a particular significantly downturn in the activity?
Yeah, I mean, it was certainly slow from April, May, June, and then kind of started to pick back up. Obviously, we were deep into the PPP loan program, so that took up a lot of our time as well during that period. But yeah, it was slow for a few months, but it's certainly starting to pick back up and lots of activity. In fact, I'm closing a deal on Friday of this week, so things are starting to move again.
Okay, and Dean, what are you seeing in the current marketplace, and are you seeing anything in particular as it relates to valuations?
Yeah, so I'll defer to Chad on valuations. I would 100% agree that the SaaS company valuations have seemed to not only to be strong to going into this, but strong coming out of it. A lot of our deals that were sort of in market when COVID hit kept moving forward. Then there was sort of a pause on the deals that were either had not quite got the letter of intent or were in the process of really early stages. And then the deals that were getting shopped, a lot of that shopping just sort of stopped as people tried to figure out how do we do management presentations, et cetera. All my own personal activity has picked back up to the point where a lot of it just got shoved into the fourth and first quarter. We've seen a lot of deal activity ramp up and almost no fall off from the COVID piece, which actually surprised me a little bit. I was anticipating a little bit more like an 08, 09 situation, or at least with respect to certain market segments. Hospitality has been just brutalized, will continue to be brutalized. And I think you're going to see, I'm going to be even interested to see if people are opportunistic in that space. but it's the activity just really ground to a halt over there. I think one of the most interesting aspects from a pure legal perspective is how to deal with PPP loans, because there isn't a lot of quality information yet to exactly what happens if you buy a business that has a PPP loan outstanding. If you bought the stock of the business, it probably is less of a big deal. But if you buy the assets, the guidance we're getting from the SBA seems to imply that potentially that you would need to get prior authorization from the bank as well as the SBA, which creates an interesting little wrinkle. Does it affect forgiveness? Is obviously the big piece of it, because if you have a $700,000 PPP loan, you don't necessarily want to jeopardize that forgiveness. And I think hopefully we'll get through that little bubble in the not too distant future, but it does create an interesting little problem, particularly as sort of we've watched, dealing with the PPP loan from a legal perspective was awful lot about trying to glean what the law could be from a series of frequently asked questions that were often confusingly written. The answers were confusingly written and sometimes contradictory. So it was a very interesting. It's basically trying to tell somebody what the law is by reading the manual on their stereo. But when all is said and done, we got through it, and it's going to be an interesting thing until those loans get forgiven. What do you do with M&A activity for some of those companies that are yet to get the forgiveness?
Okay. So a reminder to our audience that you can submit your questions into the comments field, as well as you'll find the email addresses for Chad, Dean, and Ben if you want to reach out to them. And then also hit the subscribe and like button to keep up with what's happening with Club E. All right. So we touched on this a little bit. Ben, you brought up COVID impacted results and how they're going to be received. If we shifted gears and a little bit of a crystal ball, if you said, all right, over the next 12 months, what do you think is going to happen with the M&A market? And how do you think these COVID impacted results are going to be perceived?
Yeah, I guess I'll start with that one. Obviously, the biggest unknown, in my opinion, is whether or not we have another shutdown and another situation like what happened previously. And I think as Rick alluded to, I think it depends on how clear your crystal ball is. But assuming that the economy keeps chugging along, I think compared to the prior 12 months, we might see more sellers in the market who were reminded by COVID that digging out after the Great Recession was a challenge. And this might push them to be ready to move on and sell and get on to the next adventure. I think we've been in a pretty significant seller's market for the next few years, and there will be continued capital in the market from PE, and obviously low interest rates will mean that there's a healthy supply of buyers. So I think it depends on how many sellers enter the market to kind of determine what the market will look like over the next 12 months. And I think deals will probably take a little bit longer than pre-COVID to get done, just because it takes longer to normalize the financials. And then also it takes a little bit longer sometimes for banks to get comfortable financing a transaction if there were COVID impacts, whether they're positive or negative.
Okay, thank you. Dean, Chad?
I agree with Ben. I think the biggest factor is going to be credit. Honestly, I think that was probably the biggest difference between the Great Recession and this deal was that the banks kept lending right into it and really leaned into it. There was obviously a lot of liquidity. There's still, I think, a reasonable amount of pent-up demand and liquidity in the private equity world where they have a lot of dry powder and they want to move forward. So I agree, as long as you get kind of something like a V-shaped recovery or some form of plateauing, I anticipate we're gonna be right back, continuing along with a little bit of some of the pent up seller, that maybe that the sellers that took a pause that were going to go to market in Q2 or Q3 of this year will become more and more active in Q4, Q1, and Q2 of next year.
I would agree with both Ben and Dean on those points, and maybe add a couple of other things that we've seen that I mentioned earlier. In some markets, COVID has actually been a bump, right? So we're seeing it a little bit in both ways. Is how do you adjust for what was a dip, and it's easiest if it really is a V shape, and you can see that the business was chugging along, dropped, snapped back, and it's pretty similar. And or if it were, in certain markets where people are doing especially well, we're getting the feedback, well, this is just a COVID bump, and what's sort of the real growth rate and real profitability. And I think what you're going to see people do that is maybe average or try to normalize revenue and earnings over a period of time, rather than just looking at what's the TTM or the next year or last year. The other thing that we've already seen come up a couple of times, in one case it worked quite well as a solution, was for a buyer and seller that had essentially come to terms before, but had to renegotiate when COVID hit, was the use of an earnout that basically, if earnings, within 18 months or whatever the time frame is, get back to where they were, then the valuation gets back to where it was. And so it just, a creative way to try to say, hey, we all recognize that this hopefully is a very temporary situation. But for some businesses, it is hard because they're, for example, we do a lot in the schools market, and education has come back pretty nicely, but on the other hand, schools are not back 100%. So it's not, it's going to be less of a V shape maybe than other parts of the economy. And then you also have to deal with, well, what's going to happen to state and local budgets, because they, it sounds like they're doing better than people had feared, but they're definitely taking a hit. So again, a lot of it will be impacted by what market you're in and what your situation is.
Okay. Do have a couple of questions coming in from our audience. A reminder to submit your questions into the comments field, and we will do our best to weave those into the conversation. Also, a reminder for folks that want to relive this fabulous moment, you can catch the video on our YouTube channel after the fact. That's Club E on YouTube. In addition, if you have somebody in your office or on your team that you'd like to have them watch this session, they can catch that after the fact on YouTube. Again, that's Club E channel on YouTube. All right, so from Melissa, we touched on this a little bit, and Dean, you mentioned that there's not yet some full clarity on this, but guys, why don't you comment just in general about the PPP loans being on the seller's balance sheets and how that's impacted valuations, economics, and or deal structure, at least to the extent you can, given what you know now.
Yeah, I mean, I don't think it's affected valuations at all. So far, what I've seen is it's hard to affect timing. Do we want to close before the loan is forgiven or not? There's a little bit of a risk allocation question. Is this going to be a buyer's risk, a seller's risk? This, for the most part, buyers have basically said, you took the money was spent. And so we need you to take the risk, but then the sellers are are more inclined to say, well, I'd like to get a little bit more certainty before this comes in. So I've seen that occur, and we're in the process of discussing those in multiple different verticals right now. I don't, to be honest with you, I've never been exactly clear from an accounting perspective how they treat this. Is it, ultimately becomes treated as revenue or what? But I'm sure it will all ultimately be backed out. But there will be a clear normalization in a bit. Ben alluded to this earlier. It's not fair to necessarily treat a business as if they, the COVID revenue loss is real revenue loss. On the other hand, to the point Chad made earlier, you definitely want to see that there's a recovery, and we've seen a lot of increased activity on the earnout side and earnings-based earnouts, which we hadn't seen a lot of activity on. So I'm anticipating the PPP loan, once you start getting comfort that the forgivenesses are going to happen, and we don't see blips in that area as the forgivenesses start coming in, it will ultimately have a negligible effect, other than potentially on timing and people wanting to make sure the loans get forgiven before they close.
Yeah, and I've had a similar experience where timing has been an issue, and discussions over, do you wait or do you not wait, and just the process that Dean alluded to earlier of trying to get information from the SBA on exactly what how they're going to treat these, because the question is coming up a lot, and it seems like they're starting to at least give a little bit more guidance around that. But escrowing seems to be the most common way that we're dealing with it, where people are, the sellers don't want to be penalized to say, hey, this isn't really debt because it's going to be forgiven, hopefully. And of course, the buyers are saying, yeah, but what if it's not? And so putting money in escrow until it's determined has been the most common way we've been dealing with it.
Agreed.
Yeah, certainly. Just piggyback off of what Chad and Dean said previously, escrows, certainly we're doing that with all of our seller SBA loans. And then on the buyer side, it depends if it's an asset sale or a stock sale, as Dean mentioned previously. On asset sales, I think it's a little bit easier in that we just say that none of the PPP liability transfers to the buyer. And so we've been pretty comfortable with structuring the purchase agreement in that way. And most of the time the sellers are pretty easy to work with on that. So essentially that's how we've been doing it. But yeah, it's essentially just pushed out the timing of a lot of these deals to figure out the finer details.
Okay. Another question from the audience, longtime listener, David. How do you see earnouts changing in this environment? We've touched on that a little bit, but let's spend a little more time on that. How are earnouts going to change, or are they changing in the current environment?
So I would say yes, they are. And I mentioned earlier that we've already seen some of that, where it can be a mechanism for trying to deal with the fact that, recognizing, hey, the business was an otherwise healthy business that got hit by this global pandemic, and trying to find something that should work for both parties. And this is somewhat anecdotal, but we started signing new clients back in June and July, and so we're kind of in the middle of a bunch of different processes right now. And this is anecdotal, but I feel like it's coming up more often, where people are suggesting they're concerned about the risk and the uncertainty, and so buyers, that is, are hedging by saying, hey, how about if there's a certain amount of cash at closing and a certain amount that's paid over the next couple of years, which from just a rational standpoint, you can understand why there's more uncertainty right now. And to Ben's point, yeah, we hope there isn't another huge spike and massive shutdown, but we're not out of the woods yet.
Yeah, I agree with Chad. What we have seen, I would say, as the market got frothier and it became more and more a seller's market after the Great Recession, you saw earnouts. They first worked their way, to the extent they were used, they worked their way higher up the income statement. So instead of being an earnings base, it was a revenue or gross margin than revenue, to the point where I just sort of stopped seeing them very often. I mean, they'd still be around, but they were less common than they had been before. And now I would say, right around COVID land, now you're seeing a lot more earnouts that are closer to the bottom end of the income statement. We're really talking about EBITDA, some form of after-tax net earnings, something along those lines, where you're seeing earnouts being really tied to post-COVID performance, with the idea that sellers get the benefit of the improved business activity if they can show that the market, that they basically were just adversely impacted by COVID. But I have several deals where the size of the earnout is significantly greater than you would have expected to have seen. 2 years ago, you just wouldn't have seen the mix of cash closing and earnout anywhere near as aggressive as this is, just because buyers they're willing to get the deal. They want to try to get the bridge that valuation gap with the seller, but they want to know the seller's business is going to come back.
Yeah, I think Chad and Dean nailed it. I think you're seeing more and more earnouts and larger dollar amounts, and I don't see them going away until things normalize a little bit more and we get past this COVID blip on the financials.
All right. And like Dean, that's a really good point you made about how it moves up and down the P&L. Kind of that's a good perspective, and absolutely have seen that as well.
Okay. All right, so we've talked a little bit about the environment. Now, if we were to talk a little bit about strategic acquirers, what are some of the benefits and some of the risks of working with strategic acquirers?
Well, I think a strategic acquirer, obviously the benefit is that they'll probably pay the highest dollar amount for your company, but this type of acquirer will, typically there could be some negative implications for your employees and your business legacy, because there will certainly be some changes when this type of acquirer buys your company.
Yeah,
oh, go ahead, Chad.
No, go ahead, Russ.
Oh, yeah, all right, I will let you go.
Okay, I would agree with those typically, especially that is a point about the employees and legacy. The other things that we find are that on the plus and the negative are on the plus, strategics tend to do less diligence. And they have less history of, I find that private equity firms are more likely to spend a lot more money hiring outside firms to do diligence, and then try to use that knowledge to try to even change the price when from the LOI. Strategics, in my experience, are less likely to do that, but they're also less likely to do, or they do less diligence because they tend to know the market already, right? Especially I think the really good strategic buyers, they tend to focus on their core or close adjacencies. And so they know more than a new buyer does coming into the market, and therefore they don't have to do as much diligence on it. On the flip side, they tend to be a little slower. They're harder to get a hold of. They have other priorities. The great thing about private equity firms, and I think this is one of the reasons we've seen so much activity today, is that they're paid to put money to work, right? This is their day job, is to buy companies. And so, they're out there, they're aggressive, they're trying to get deals done, and they make quick decisions, they give you quick feedback. And I will even say, because I tend to agree with Ben that, usually a strategic will pay more and can justify paying more. But we've had a couple of auctions in the last few years where we thought a strategic would win and a private equity firm did, just because they really liked a space and had a thesis and wanted to get aggressive. And so they're a great group of buyers to look at as well.
Yeah, I let Chad talk because I thought he'd answer the question better than I could. And he did.
All right. So how about potential buyers? Chad touched on a little bit, brought PE, the private equity guys into the conversation, but which potential buyers are the most as well as the least active, and what sellers are the most sought after? We've touched on a little bit SaaS and the recurring revenue, but again, what are the most and least active buyers, and what sellers are the most sought after?
Well, I'll touch on the latter. I mean, my opinion on the former, whether there's a lot of buyer or what the least active buyers, I would say it's incredibly industry specific, based on how much they've been impacted by COVID. If their business has not been beat up by COVID, if it's doing well, if they still have healthy balance sheets and ability to borrow, they're like I said, they're probably just as active as they were pre-COVID. If they're dealing in markets that have taken significant impacts, unless they're in a position to be opportunistic buyer, a lot of those people have hunkered down, cut costs, saved cash, and made sure their business is going to weather the storm, not knowing exactly when the COVID and the regulatory impact is going to change. On the seller side, I think it's kind of your typical, the SaaS model for sure on the IT stuff is definitely going to continue to be hot. Anytime you have like a high gross margin, stable revenue companies with high growth potential, you're going to be on the higher, the higher end of the price spectrum, and then people are often going to chase those kind of businesses. So again, it's probably fairly specific in the industry or your company or what your product is, but if you have the more gross margin you can command, the stronger your EBITDA as a percentage of revenue, and the stability, you're always going to, you'll always be one of the most sought after buyers. sellers, I'm sorry.
Yeah, I think those are very good points. Agree with those. Certainly recurring revenue is something that people have really been sought after in recent years. Growth is really important. It's one of the things that buyers are looking for. Agree that that a lot of it is industry specific. I think one thing I've noticed about PE firms, and I've heard this from a couple other people as well, that it does seem like depending on what sectors the PE firms are in and where they are in their fund's life cycle might dictate right now how aggressive they're being. Right after COVID, most firms said, hey, we got to focus on our existing portfolio companies, make sure they're stable, liquid, figure out if there's issues we have to deal with before they started thinking about buying new companies or doing more new investments. It seems that firms that have newer funds are being a little more active and a little more aggressive right now. And firms that might have already been, fairly well invested with their fund are a little more focused on add-ons rather than, big new investments of a platform we call platforms, and more on, hey, let's just add things on to our existing portfolio companies. Whereas the companies with newer funds are a little bit more aggressive is just one thing we've seen.
Yeah, I think the other guys nailed it.
Okay. All right, let's
Rick, you should let Ben go first next time.
All right, Ben, this question is just for you. Good job teeing that up, Chad. I appreciate that. Give you an extra $20 for your fee today to tee that up. All right. So let's shift gears and talk a little bit about the buy side. I know, Ben, that's where more of your practice is focused on. For the business owners out there who might be considering an acquisition, what advice would you give potential business buyers?
Yeah, so I guess from a macro perspective, an experienced deal team is just as important on the buy side as it is on the sell side. And so depending on the complexity of the deal, you might want to have an investment banker involved. Obviously, you'll want an attorney involved to help with the finer legal points of the deal. You'll want a CPA involved to help with financials and projections. And of course, you'll want a commercial banker as well, unless you have the dry powder to buy the whole company yourself. But I guess just when dealing with your deal team in general and your banker more specifically, it's just important to understand that that everybody's priorities are aligned, and your business banker wants you to be successful just as much as you do. And so just having that open line of communication and staying in touch with them and providing timely updates is important with your whole deal team.
Rick, you can ask Ben questions all the time as long as he's going to plug Chad and my services.
Any comments on from the buy side perspective? Any advice to business buyers?
Well, our firm does a fair amount of buy side work, and so one of the things that we've noticed, and it really is piggybacking on what Ben said, certainly want to have a good deal team. Absolutely want to have a great lawyer, a great firm like Winthrop and Weinstein. But you also want to be thinking about what is your core business and what are the adjacencies that are most attractive. There's been research done and some great books written about the difference of investing in your core or things that are either closely adjacent or far adjacent. And if you think about the business in that way, we've absolutely seen it over, the 40 years that we've been a firm, is that deals are a lot more successful when you're investing in your core, right? Because again, the markets, the customers, what the employees do, and that things can be successful when you're closely adjacent. It can get you into new markets. It can get you new products for your existing markets. There can be a lot of things that make sense But when we've seen people get in trouble, it's when they take that strategy work a couple of steps forward and they don't realize that they're now buying products that they don't deal with today, dealing with customers they don't deal with today. And it's not saying that that can't be successful, but the odds absolutely go down if that's the case. So really thinking through how well this fits, what is the rationale for the acquisition is really important.
Anything to add there, Dean?
No, the other thing I go back to is the old Kenny Rogers question. Know when to hold them, know when to walk away, know when to run. I mean, the only thing I'll say, if on a buy side, the more experienced buyers are probably either the strategic buyers who are doing this all the time, or the private equity buyers who, who've done this. They probably are more familiar with this. But if it's a recent acquisition, don't be afraid if you get to a point where you see something you don't like, and if you're acquiring a business and there's something you don't like, and don't be afraid to go back to the seller and talk about it. And if you can't reach a resolution, work on a purchase price negotiation. But if you can't close, if ultimately you can't bridge that gap, don't get yourself in a position where you just don't have any other choice other than to do that acquisition, because those are frequently the worst. Those are the ones that have problems. Those are the ones where you're inevitably dealing with fights afterward. It can be a massive distraction to your business. In addition to the fact that you want to find ones that are closely adjacent to what you're doing. But if you get too pregnant in a deal and you feel like you have to do it for a series of reasons, that's the deals that often are the ones that people regret when they're done.
So Ben, as you said, Dean did a nice job of teeing you guys up to be a part of deal teams. But just for the audience out there, when's the right time to pick up the phone and reach out to you, Chad and Dean? How early do you want to be brought in the process?
Well, my own 2 cents, and this is not self-congratulatory, but the sooner we are involved, frequently the better, because we don't have to spend a lot of time on the front end, particularly for the preliminary conversations. But if we can give helpful feedback, give thought, what I would really love to do is be involved years before the process, where we're talking to people and really trying to plan out and deal with some of those landmines and pitfalls we talked about earlier. That's usually where we can add a lot of value. But sometimes people give us a signed letter of intent and they said, okay, we're going to do this. And you look at the letter of intent and there's a lot of things that they agreed on, which put them in a pretty tough spot as we go further into the transaction, that they could have probably got a lot better position on had they had really kind of understood the full landscape at the beginning. Things like deal structure, economics, there's obviously legal pieces of it, but the sooner you get someone talking to you, frequently it's one of those penny wise pound foolish things. If you're smart, if you as a buyer or a seller are smart on the front end as far as what you need to ask for, and you ask for it while your leverage is the highest, if you're a seller, while you're at the table negotiating the letter of intent, that's usually where you're going to get some of these things taken care of quickly and efficiently, as opposed to having to negotiate them out and going through all the brain damage later in the process, where you may have already agreed to something that you really would have been better off not doing.
Yeah, I completely agree. And I was thinking the same thing. 2 years would be ideal, right? And it goes back to that first question about the plan, is let us, talk about what you should expect, what things you can do to prepare, make sure you're not going to have any surprises. When you brought up the question, Rick, where you were talking about, what sellers are the most sought after, the cynical, self-congratulatory side of me was saying, yes, buyers are looking for sellers without bankers, right? Because part of it is they want to establish that relationship, and totally get that. But again, there's just so much more that they know and that they're experienced with, if they're truly experienced buyers, that they would love to just have an LOI and have you bring that to Dean. And I've seen that happen. And Dean looks at it and goes, guys, okay, this is great. I want to help you here, but there's a bunch of different things that really could have been a lot better. And it's not impossible at that point, but it's a lot harder. So certainly that's something to think about. And I should add too, just on the buy side, and I, maybe Ben, this is what you were saying as well, but talk to Ben well in advance, because as somebody that's representing sellers, if you come to me and you've got a letter from Ben saying, yeah, we've looked at this deal and they're ready to finance it, and obviously we have to do our diligence, so this isn't, we're not signing in blood here, but you are a much stronger buyer and much more credible. And so it reinforces that idea that if you're talking to your deal team, you're working with people well ahead of time, whether you're on the buy side or the sell side, you're just going to be in a lot better position.
Yeah, certainly. That's a great point, Chad. I mean, we're willing to get involved at any stage of the transaction, but obviously the earlier the better. And, we have put together letters like Chad mentioned, and it does certainly help in the bidding process.
All right. So you three are all in the advice business, but if you flip that around and said, what was good advice that you received? So if in looking back at the exit market, or I guess at either way, buy side or sell side, what's the best advice you've ever been given regarding buying and selling companies?
Well, I'll go first. I have an uncle who was a CEO and did some M&A, and just something that he said once to me that really stuck with me was the importance of establishing relationships. And in his case, he was talking about with potential targets, with people, companies you want to buy. But I see it for sellers as well. I see it for, professionals like all of us here. But, the importance of letting people know, hey, just because they're not interested in selling to you today doesn't mean they won't be interested in selling to you a year, 2 years, 3 years down the road. And, he told me this great story about a business that he'd been courting for years, and, making time to talk to them, doesn't just being straight with them. And when the time came for them to sell, even though they should have called their banker and their attorney and their first, they called him first and said, okay, we're ready to sell. Would you pay this amount? And he said, yep. And, next thing he did, the next day he's out there working on a deal with them. So that was advice that always stuck with me and definitely has been reinforced in my career.
Yeah, a little bit to piggyback off that. I think probably the best advice I ever got is, it's a small town, it's a small market. Whether you're in Minneapolis or even anywhere in the world, I've seen deals where we're sitting down looking at two letters of intent, and one of them was higher than the other one, and I've had the banker tell me, or I've had the CEO tell me, I'm not going to take the higher one because those guys are fill in the blank. Can you say whatever you want on YouTube, Rick, or is there certain rules?
We're a family-friendly thing here.
Okay.
Let's soften it a little bit.
No, and they will not take a higher offer because they think that these guys are unlikely to close, or because they have a reputation for being likely to retrade on a deal and renegotiate it later, or because they just have a reputation of people that are difficult, right? And so and this wasn't even a local example. This was a company, a company we sold to a East Coast private equity firm, but another East Coast private equity firm. But I've seen that example play out on more than a few occasions, where somebody says, I'm not going to close with those guys because I've heard they can be in whatever that answer is. And so, think about what, if you're an acquirer, or a seller, think about what your reputation is in the community, because even if you're on the sell side and you have a history of being a difficult player to be with, you might scare people away because, everybody's sophisticated. We like to pat ourselves in the back. We're all human beings. Human interaction has a lot to do with how people feel and how they act and how they behave. And if you have your reputation of being someone that people don't want to work with, you're going to affect your ability to sell, and you're potentially going to lose deals on your ability to buy.
Yeah, I completely agree with Chad and Dean. Relationships and reputation are certainly very, very important. I guess I'll take a little bit of a different approach at this question, and this is more applicable to individual sellers. And something interesting I heard a few years ago that I hadn't really thought about, being a little bit younger and earlier on in my career, is that you need to have the owner readiness piece set to go as well. You need to have something lined up to do after you sell your business, because you pour your life and your soul into this business for so long, and then you sell it. And, assuming you're not staying on as some kind of consultant thereafter, you need something else to fill your time and be passionate about. So thinking about that before you exit is important.
Okay, great. So last couple questions here. As a business owner begins to prepare for that exit, what's something they can do right now to start that process?
Putting your deal team together. I think that we talked about that. It's never too early to do that.
Yeah, I would say make a little Gantt chart to decide when you're going to sell what we need to do in the beginning, and then leveraging that deal team to help fill in that Gantt chart and figure out what are your work streams, what you need to accomplish. Hopefully, you have an exit plan that doesn't involve you selling in 2 months. Sitting down and working backwards. Okay, if I want to retire at the end of next year, what do I need to do to get there, so that you don't end up being late to the game.
I agree with both those things, and as part of that is that what are your goals? Just really thinking through and writing down, what do I want to accomplish?
Okay. And then as we end up the year here and start doing planning for next year, great time to figure out what the goals are and developing, as you said, Dean, work streams to check off things off of the list that need to get done. All right, last question here. If you had to leave one thing with our audience today, what's the main takeaway that you'd like to leave with them? Could be something that we covered on that you'd like to reiterate, might be something that we didn't get to that you'd like to share, but what's one main takeaway you'd like to leave with our audience?
I'd say get educated, whether that's the deal team, whether it's starting to leverage relationships, whether it's starting to put together a timeline. Get educated, learn what you need to learn if you haven't done this before, and leverage relationships. You can do all that stuff for free. I'm sure any of us would sit down, have lunch with, any of us or anyone like us would sit down and have lunch with you and start talking about it, start asking questions. Don't come to the table without enough knowledge, because it's just you're the only one that's going to get impacted by it. And it's a pain, because you want to operate your business. You want to make sure you're dealing with the PPP, you're dealing with the employees. But the sooner you can start really thinking about understanding a lot of this stuff, the sooner you can start making decisions with exit in mind, as opposed to making decisions with next quarter in mind.
I will. I'll piggyback on that as well and say that, there was a phrase that we often use here that says that I should give proper credit to my colleague, Chuck Gorman, who some people in the Twin Cities here might know. You need to heat the iron before you try to bend it, right? And so just keep that in mind. Preparing is really important. And I guess the other thing that to take away from today, sorry, Rick, that's two things, would be that there is still a lot of activity going on, right? That markets really have come back. So that's not to be lost as well.
Yeah, I guess I would say just kind of highlight something that Chad mentioned earlier, is just understanding your goals as a seller and understanding exactly what you want to accomplish, so that you can properly convey that to your deal team, and they can put together the best deal possible for you.
All right. So a reminder to everybody, you can find the email addresses for Chad, Dean, and Ben in the comments field. Similarly, yes, Chad.
Rick, sorry to interrupt you, but I thought I wanted to add, if you're not ready to exit yet and you're just really focused on growing your business, then Rick's the guy you need to be calling. So.
Good point. Yes, absolutely. Anyway, so thanks, Chad, for that plug. Again, you can find Chad, Dean, and Ben in the comments field, their email address, or reach out to me. Again, subscribe and like the Club E channel. And you can go back because this content was so good. I'm sure you're going to want to watch it again. You can go back and catch it on YouTube. That's the Club E channel on YouTube. Gentlemen, thank you for today. Look forward to having you back and appreciate your time.
Thank you, Rick.
Thank you.
Thanks, Rick.